want to get a handle on mutual funds. Understand what they are, how they work, all the different options, but without getting totally bogged down in jargon. Well, you're in the right place. We've been digging into this comprehensive chapter on mutual funds, really pulling out the key stuff for you.
Exactly. The goal here is to take all this information and really boil it down to the essentials you need to know. Think of it as your shortcut to understanding mutual funds. We highlight what really matters.
Okay, so let's jump right in. Basically, at their core, mutual funds are a way to invest in a whole mix of assets. We're talking stocks, bonds, maybe even gold or real estate. And the key is you don't have to buy every single thing yourself. It's more like a collective investment pot.
Right. And to make sure this all runs smoothly and, importantly, securely, there are a few key players involved. You've got the sponsor. They're the ones who kind of kick things off. Then there are the trustees. Think of them as guardians, making sure investor interests are protected. And then you have the asset management company, the AMC. They handle the day-to-day stuff, managing the investments, marketing, handling your transactions.
And crucially, this isn't the Wild West. It's regulated. All these entities operate under the watchful eye of SEBI, the Securities and Exchange Board of India. That oversight is really important for protecting you, the investor.
Absolutely. And when a brand new fund is launched, that's called a new fund offer, or NFO.
Right, the NFO.
And every NFO comes with this detailed document, the offer document. This is your key resource. It lays out the fund's investment objective, like what's it trying to achieve. It also details the strategies it'll use, and importantly, all the fees and expenses involved. SEBI actually mandates what has to be in there so you can make an informed decision.
Okay, let's dig a bit deeper into some of the fundamental ideas here. One of the first things you'll see is the investment objective. Sounds a bit like financial jargon, maybe?
It does, but it's actually really critical. The investment objective tells you exactly what the fund is aiming for. Is it all about growth? Is it trying to provide steady income? Or maybe a mix? Knowing this helps you figure out if a fund actually fits with your own goals and, how much risk you're comfortable taking, whether you're prepping for a meeting or just curious. Understanding that objective is step one.
Now, when you invest, you're not buying shares directly, are you? You get units in the fund instead.
Exactly. Like buying slices of a pie. So if, say, GTX Equity Fund launches at 10 rupees a unit and you put in 5,000 rupees.
You'd get 500 units.
Right. And someone putting in 10,000 gets 1,000 units. Simple as that.
And the total value of everything the fund holds, its stocks, bonds, whatever, minus the fees and costs, that's called the net assets.
Correct. Net assets. And that value isn't static. It goes up if more people invest, or if the investments themselves increase in value, or if they earn income.
And conversely, it goes down if people redeem units, or if the investments lose value, or, when the fund pays its operating costs. It's always moving.
It's dynamic, yeah. Now, to figure out the value of each individual slice, each unit, we calculate the net asset value, the NAV.
The NAV. Hear that a lot.
You do. It's just the total net assets divided by the total number of units out there. Yes. So NUM Equity Fund has, say, 1 lakh rupees in net assets and 10,000 units held by investors.
The NAV is 10 rupees per unit.
Exactly. It's the per unit market value of what the fund owns, essentially.
And naturally, as the value of those underlying stocks and bonds goes up or down, or as people buy and sell units, that NAV changes too.
Well, yes and no. If the fund's investments go up, the NAV rises. But interestingly, if investors redeem units, both the total assets and the number of units decrease. So the NAV itself might not actually change just from that transaction.
Okay. So it really reflects the performance of the underlying assets on a per unit basis.
Precisely. And when you buy or sell, you generally transact at that day's NAV. The fund then either creates new units for buyers or cancels units for sellers. Those transactions themselves don't directly shift the NAV for everyone else holding units.
Okay, timing. Always seems to be critical in finance, doesn't it? That brings us to cutoff timings.
Yes, super important for fairness. Mutual funds have specific deadlines each day for accepting your buy or sell requests. If you get your request in before the cutoff time, you generally get the NAV calculated for that business day. If you miss it, you usually get the next business day's NAV.
Right. Keeps it fair for everyone. No one gets an unfair advantage based on knowing information released later in the day.
Exactly. It ensures a level playing field for valuing those transactions.
So how do they keep track of the value of all those different investments inside the fund, especially when prices are changing all the time? Is that where mark-to-market comes in? Sounds a bit technical.
It sounds technical, but the concept is pretty straightforward and vital for transparency. Mark-to-market just means the fund values all its holdings, stocks, bonds, etc., at their current market price every single business day. This gives a real-time snapshot of the fund's worth and is the basis for calculating that daily NAV.
And what if something doesn't trade very often? How do they value that?
Good question. SEBI has guidelines for that too, for valuing less frequently traded securities to ensure a fair assessment. This daily revaluation is absolutely essential for an accurate NAV and, for giving you a clear picture of how the fund is doing.
Okay, solid foundation there. We know what mutual funds are, the key terms. Now, let's explore the different types of schemes. The chapter seems to group them based on how you can get in and out.
That's a good way to put it. You've basically got open-ended, closed-ended, interval funds, and ETFs, exchange-traded funds. Let's start with open-ended. They're probably the most common type people run into.
Right, open-ended. So you can buy and sell units pretty much any time directly with the fund at whatever the current NAV is.
Exactly. The fund size isn't fixed. It just grows or shrinks as people invest or redeem. And they're usually designed to run indefinitely unless, the investors vote to wind things up.
Okay, flexible access. Now, closed-ended schemes sound, well, less open.
They are. They have a fixed lifespan, maybe 3 years, 5 years, something like that. You can typically only invest during the initial NFO period.
And after that?
After the NFO, the door closes for new money coming directly into the fund. If you want out before the scheme matures, you usually have to sell your units to another investor on a stock exchange. These funds have to be listed for that reason.
So you need a buyer on the stock exchange.
Correct. Then, at the end of the fund's term, the AMC redeems all the remaining units at the final NAV, and the scheme wraps up. It's a bit like a bond maturing.
More restricted, then. What about interval funds? The name suggests maybe something in between.
Yeah, that's a good way to think about it. They're basically closed-ended funds, but they have these specific preset periods, maybe a few days every quarter when they do open up. During those intervals, you can buy or sell units directly with the fund, kind of like an open-ended fund, but there has to be at least a 15-day gap between these transaction windows.
And are they listed too?
Yes. Like closed-ended funds, they also have to be listed on an exchange. So it offers a bit more flexibility than a standard closed-end fund, but not the constant access of an open-ended one.
Interesting. A sort of middle ground. And finally, ETFs. Exchange-traded funds. These seem to be everywhere lately.
They've definitely become very popular. ETFs are technically mutual funds, but they trade on stock exchanges like individual stocks. Big difference from traditional funds that calculate NAV once a day.
So you can buy and sell them throughout the trading day at changing prices.
Exactly. Their prices fluctuate based on supply and demand in the market, just like a stock. A lot of equity ETFs are designed to track an index, like the Nifty or Sensex, or maybe a commodity like gold.
And when I buy or sell an ETF, am I dealing with the fund company?
Usually not directly. You're typically buying from or selling to another investor on the stock exchange. With an open-ended fund, your transaction is usually directly with the mutual fund company itself. That's a key difference.
Okay, that clarifies the main structural types. Now, who's making sure all these funds play by the rules and operate fairly? Let's touch on the regulatory side.
Right. The main regulator, as we mentioned, is SEBI, the Securities and Exchange Board of India. They have a pretty comprehensive set of rules. The SEBI Mutual Funds Regulations from 1996, which get updated regularly. These rules cover pretty much everything: setting up a fund, launching schemes, how portfolios are managed, investor rights, the responsibilities of the AMC, trustees, the whole 9 yards.
So SEBI is the big one. Any other players involved in overseeing things?
Well, the Reserve Bank of India, the RBI, has a role too, especially concerning foreign exchange. So, if an Indian fund invests overseas or a foreign investor puts money into an Indian fund, RBI rules on currency exchange come into play. They also oversee how banks interact with the industry.
And AMFI. We hear that name a lot. Association of Mutual Funds in India. What do they do?
AMFI is the industry's own body. It's like a self-regulatory organization. They promote ethical conduct, professional standards, best practices. They also represent the industry when talking to regulators like SEBI, the government, and other stakeholders. They play a big role in trying to ensure the market's integrity and growth.
The chapter also mentioned something new, MF Lite regulations. What's that about?
Yeah, that came into effect end of 2024. NF Lite is basically a streamlined set of rules specifically for funds that only offer passive products, think index funds and ETFs. The idea is to potentially create a simpler regulatory path for these types of funds.
Sounds like it could make things more efficient for those passive fund providers. It's also good to know SEBI sets standards for things like how quickly funds need to process your requests, and what info they have to give you.
Absolutely. SEBI mandates turnaround times for things like allotting units in an NFO or processing redemptions. They also dictate the kind and frequency of information funds must provide to investors, things like portfolio disclosures, NAV updates, all aimed at transparency.
Okay, foundation laid, regulations covered. Let's get into the actual products you can invest in. SEBI seems to have a clear categorization system for open-ended funds.
They do. Broadly, they group them into 5 main buckets: equity schemes, debt schemes, hybrid schemes, solution-oriented schemes, and then a catch-all category called other schemes. Helps you quickly get a sense of a fund's main focus.
And there's that rule, 1 scheme per category per fund house mostly. That sounds like it could simplify things quite a bit for investors, stop them launching loads of similar funds.
It generally does, yes. The aim was to reduce clutter and make it clearer what each fund actually does, but there are logical exceptions, of course.
Like what?
Well, a fund house can have multiple index funds or ETFs if they track different indices. Makes sense, right? They can also offer various fund-of-funds investing in different underlying schemes, and they can have multiple sector or thematic funds if they focus on distinct sectors or themes.
Okay, let's tackle the big one, equity funds. These are mostly about stocks, right? So higher potential returns, but also, more risk.
That's the fundamental trade-off. Equity funds mainly invest in company shares, so their ups and downs tend to follow the stock market. And within equity, there are lots of different ways funds can be categorized based on their approach.
Right, like passive versus active management. That seems like a basic split.
It is. Passive funds just try to mirror a market index like the Nifty 50. The manager isn't picking stocks, they're just holding what's in the index in the same proportions. Minimal decision-making involved.
Lower cost, usually.
Typically, yes. Active funds, on the other hand, have a manager actively researching and selecting stocks they think will beat the market or the index. Potential for higher returns, but also the risk the manager gets it wrong.
Okay. Then there are diversified equity funds. What makes them diversified?
They aim to spread their investments across different industries, different company sizes, what we call market capitalization, and different market segments. The idea is to lower the overall risk compared to putting all your money in one specific area. Some can be closed-ended too, by the way.
Makes sense. Don't put all your eggs in one basket.
Yeah.
Now, market capitalization seems key for equity funds. How does that break down?
Absolutely. Market cap is just the total value of a company's shares. SEBI has categories based on AMFI's rankings. That's the Association of Mutual Funds in India.
So large cap funds first. Big established companies.
Exactly. Top 100 companies by market cap. A large cap fund has to invest at least 80% of its money in these big guys, generally seen as more stable, maybe less explosive growth potential compared to smaller ones.
Then mid cap funds, the middle tier.
Right. Companies ranked 101 to 250. Mid-cap funds need to put at least 65% of their assets here. Often seen as having higher growth potential than large caps, but definitely riskier too, more sensitive to economic swings.
And small cap funds. Highest growth potential, but also highest risk.
That's generally the perception. These are companies ranked 251 and below. Small cap funds must invest at least 65% in these smaller players. They can offer significant returns, but they're also the most volatile and vulnerable in downturns.
We also saw large and mid cap funds. A mix, presumably.
Precisely. They blend the two. The rule is minimum 35% in large caps and minimum 35% in mid caps, trying to balance the stability of large caps with the growth potential of mid caps.
What about multi-cap funds? Sounds like they can invest anywhere.
Pretty much. They invest across large, mid, and small caps. The rule is they need at least 75% in equities overall, but importantly, they must have a minimum of 25% in each of the large, mid, and small cap segments. So quite diversified across sizes.
And flexicap funds also sounds flexible. How are they different from multi-cap?
The key difference is flexibility. Flexicap funds also invest across large, mid, and small caps and need at least 65% in equities overall. But crucially, they don't have those minimum allocation requirements for each cap size like multi-caps do. The manager has full discretion to shift between cap sizes based on their market view.
Okay, that clears up the market cap categories.
Yeah.
What about funds focused on specific sectors? Like just banking or just tech?
Yes, sector funds do exactly that. They invest mostly at least 80% in companies within a single industry like banking, pharma, IT, auto, etc.
Yeah.
Because they're so concentrated, they carry higher risk. Their performance is tied directly to how that one sector is doing, which can be very cyclical.
So you really need to time your entry and exit well with those. How do theme-based funds differ?
Theme-based funds are also focused, but broader than a single sector. They invest across multiple sectors linked by a common theme. Think infrastructure, for example.
Ah, so that could include construction, cement, maybe banks, financing projects, logistics.
Exactly. It cuts across sectors but revolves around that infrastructure theme. They're more diversified than sector funds but still concentrated around the theme. They also need to invest at least 80% according to the theme. ESG, environmental, social governance, is mentioned as a big theme now too, with different approaches like excluding certain industries or actively seeking positive impact.
Interesting distinction. Now, investment style. What does that mean?
It's about the manager's philosophy for picking stocks. Take value funds. They look for companies that seem cheap, trading below what the manager thinks they're really worth, their intrinsic value.
Hoping the market catches on eventually.
Right. It often takes patience, but the idea is the price will eventually rise to reflect the true value. Value funds need at least 65% in equity.
Then there are contra funds, going against the grain.
Exactly. Contra investing means buying stocks or sectors that are currently unpopular or underperforming, maybe due to temporary issues. The bet is they'll recover. It's a contrarian approach. An interesting rule is that a fund house can offer a value fund or a contra fund, but not both.
Okay. What about dividend yield funds? Sounds like they focus on income.
They do. They primarily invest in companies known for paying out regular, relatively high dividends. These are often mature, stable companies, maybe with less explosive growth potential. The focus is income generation for the investor. They also need minimum 65% in equity.
And focus funds, concentrated bets.
Precisely. These funds hold a limited number of stocks. SEBI caps it at a maximum of 30. The manager has high conviction in these picks, potentially higher returns if they're right, but definitely higher risk because it's not broadly diversified.
Got it. And lastly, for equity, ELSS, tax savers.
Yes, equity-linked savings schemes. They offer tax benefits under Section 80C, well, under the old tax regime anyway, up to the limit. The trade-off is a mandatory 3-year lock-in period. They have to invest at least 80% in equities.
Phew, that's a lot on equity funds. Okay, shifting gears to debt funds. These are more about bonds, fixed income, aiming for regular income, right?
That's the core idea. Debt funds invest in things like government bonds, corporate bonds, money market instruments. The main aim is usually income from the interest payments, the coupons.
And there's a risk difference between government and corporate bonds.
Definitely. Government bonds generally have very low default risk. They're backed by the government, but typically offer lower returns. Corporate bonds offer potentially higher returns, but they come with credit risk, the chance the company might not be able to pay back its debt.
The chapter mentioned credit ratings being important here.
Very important. Rating agencies assess how likely a company is to default. Higher ratings mean lower risk. Lower ratings mean higher risk. Fund managers use these ratings heavily. And you also have to consider interest rate risk.
Ah, yes, the inverse relationship. Rates go up, existing bond prices go down.
Exactly. And longer-term bonds are much more sensitive to those rate changes than short-term ones.
Okay, so debt funds are also categorized by maturity. Let's start really short-term.
Right at the short end, you have overnight funds, investing in things maturing in just one day. Very low risk. Then liquid funds, investing in debt maturing in under 91 days, often used for parking cash short-term because they're, well, liquid and low risk.
Slightly longer.
You get ultra-short duration funds where the Macaulay duration, that measure of interest rate sensitivity, is 3 to 6 months. Low duration funds are 6 to 12 months Macaulay duration, and money market funds invest in instruments maturing up to 1 year. All these are generally low on interest rate risk.
So considered relatively safe places for short-term money.
Generally, yes. Now, moving out a bit longer, we have funds where the manager's view on interest rates starts to play a bigger role.
Like short-duration funds.
Exactly. Their Macaulay duration is 1 to 3 years, medium duration funds are 3 to 4 years, and medium to long duration funds are 4 to 7 years. An interesting point for the medium and medium to long categories is they have flexibility. They can actually shorten their duration down to 1 year if the manager thinks rates are going to move against them.
Okay, and then the long-term debt funds. These must be much more sensitive to rate changes.
They absolutely are. Long-term funds aim for total return, that's both interest income and potential price gains if rates fall. Because they hold bonds with longer maturities, their NAVs can swing quite a bit more with interest rate movements.
And within long-term, there are more specific types.
Yes. You have long-duration funds with Macaulay duration over 7 years. Corporate bond funds must put at least 80% into high-quality corporate bonds rated AA+ or higher, relatively low credit risk for corporates. Then, credit risk funds deliberately take on more credit risk. They invest at least 65% in corporate bonds rated AA or lower, chasing potentially higher yields. Banking and PSU funds focus on debt from banks, public sector companies, financial institutions, minimum 80% there.
What about gilt funds, government securities only?
Mostly yes. Open-ended gilt funds invest at least 80% in government securities, GSECs, of various maturities. No default risk, but very sensitive to interest rate changes. There are also specific gilt funds targeting a 10-year constant duration, making them very sensitive to long-term rate moves.
And dynamic bond funds. Sounds like they shift strategy.
That's the idea. They actively manage both interest rate risk and credit risk. They can shift across different types of bonds and maturities based on the manager's view of the market. Much more flexibility than funds with fixed duration targets.
Floating rate funds, how do those work?
These invest mainly at least 65% in bonds where the interest rate isn't fixed. It resets periodically based on some market benchmark. This means they generally have lower interest rate risk because their coupon adjusts to market rates.
Okay. We also saw some closed-end debt funds mentioned, like FMPs, fixed maturity plans.
Right. FMPs are closed-end. They invest in bonds that mature around the same time the FMP itself ends. The goal is to lock in a yield and largely eliminate interest rate risk if you hold till maturity. They tend to be popular when interest rates are high or rising.
And target maturity funds, TMFs. Similar, but open-ended.
Yeah, TMFs also have a specific maturity date, and their bond portfolio's average maturity rolls down towards that date. But key differences. TMFs are typically open-ended, offering more liquidity than FMPs, and they often cover a wider range of maturities.
Okay, that covers debt funds thoroughly. Let's move to hybrid funds, mixing debt and equity right.
Exactly. Hybrid funds invest in both. The mix depends on the fund's objective. And that mix, that asset allocation, really determines the fund's risk and return profile. More equity usually means more potential return, but also more risk.
And lots of different types here too, mainly based on that mix. Let's start with conservative hybrid. Mostly debt.
Yes, conservative hybrid funds lean heavily towards debt, usually 75% to 90%. The smaller equity portion, 10% to 25%, aims to give returns a little boost. They focus on income and stability, relatively low risk, and they're taxed like debt funds.
Then balanced hybrid funds. More even split.
Pretty much. They aim for a balance, investing somewhere between 40% and 60% in debt, and the remaining 40% to 60% in equity. Trying to get the best of both worlds, you could say.
And aggressive hybrid funds, tilting towards equity.
Correct. These are equity heavy, with 65% to 80% in equity and only 20% to 35% in debt. The debt part provides a bit of a cushion. Important note, a fund house can usually offer either an aggressive hybrid or a balanced hybrid, but not both.
Okay. What about dynamic asset allocation funds or balanced advantage funds? Sounds like they adjust the mix actively.
They do. They use formulas or manager discretion to shift the allocation between equity and debt based on market conditions, valuations, etc. They might even use derivatives to manage the equity exposure while often trying to stay above 65% equity for tax purposes. Very active management.
Multi-asset allocation funds sound even more diversified.
Yeah, they go beyond just equity and debt. They have to invest in at least 3 different asset classes with at least 10% in each of those 3. The manager decides the mix based on their outlook for each asset class. Note: foreign securities don't count as a separate asset class for this rule.
Arbitrage funds, how do they fit in? Sounds specialized.
They are. They try to profit from tiny price differences for the same asset, like a stock, between the cash market and the derivatives market. Buy low in one, sell high in the other simultaneously. It's about exploiting temporary mispricings, considered low risk.
And equity savings funds, another mix.
Right. They combine equity, debt, and arbitrage strategies. They need minimum 65% in equity and equity-related stuff, which includes the arbitrage part often, and minimum 10% in pure debt, aiming for equity-like returns but with potentially lower volatility.
The chapter also mentioned a closed-end hybrid, capital protection funds. How do they work?
These are closed-end funds designed primarily to protect your initial investment amount by maturity. They usually invest most of the money in high-quality debt timed to mature at the fund's end date, aiming to return the principal. The rest is often invested in equity derivatives to try and generate some upside potential.
Okay, that covers hybrids. Now, solution-oriented schemes, tailored for specific life goals.
Exactly. Designed to help you save for particular things. 2 main types mentioned.
Retirement funds. Pretty self-explanatory. Saving for later life.
Yes. Specifically for building a retirement nest egg. They have a lock-in minimum 5 years or until retirement age, whichever is later, encourages long-term saving.
And children's funds for kids' futures.
Correct. Aimed at saving for things like a child's education or wedding, they also have a lock-in, usually 5 years or until the child turns 18. Again, promotes goal-based long-term investing.
Yeah, those lock-ins make sense for the goals. Now, the other funds category seems like a mix of specialized stuff.
It is. Includes fund of funds, FOFs, ETFs, which we've touched on, specific commodity ETFs like gold and silver, and some less common ones like real estate funds, infrastructure debt, and specialized investment funds. Let's start with fund of funds.
So these funds invest in other funds.
Precisely. Instead of buying stocks or bonds directly, an FO buys units of other mutual fund schemes. The underlying funds determine if the FO is equity-oriented or debt-oriented. The rule is they have to invest at least 95% in these underlying funds.
Can they invest in funds from different companies?
Yes. They can invest in funds from the same fund house or spread it across multiple fund houses. Those are sometimes called multi-manager FUFs.
Is there an extra layer of cost with FEFOs?
There usually is, yes. You're paying the expenses of the underlying funds plus the expenses of the FEF itself, so potentially higher overall costs. And the tax treatment, especially for equity FEFs, might differ from investing directly in equity funds, something to be aware of, especially after recent changes mentioned.
We talked about ETF structure, but specifically gold and silver ETFs, investing in metals without holding bars.
Exactly. They track the domestic price of gold or silver. Each unit usually represents a certain amount of the metal. The fund holds physical gold or silver or related instruments. It's convenient, but returns might be slightly less than the metal's market return because of the fund's expenses and maybe some cash holdings.
Real estate mutual funds were mentioned too, but noted is not launched yet.
Correct. The rules exist for them. They'd invest in properties or real estate company stocks, structured as closed-end listed funds. But yeah, as per the source, none have actually hit the market yet. An interesting potential future development, maybe?
Infrastructure debt schemes. Sounds very specific.
It is. Closed-end, minimum 5-year term. They invest mainly at least 90% in debt issued by infrastructure companies. High minimum investment, NAV disclosed quarterly, listed on exchanges. The people running them need specific infra experience. Targets institutional or H&I investors mostly.
They're finally specialized investment funds. Sounds sophisticated.
It is. A newer category, high entry ticket, minimum 10 lakh rupees. They offer access to strategies not usually found in regular MFs, like complex derivative strategies beyond simple hedging, long-short funds, or curated high-yield debt portfolios. Kind of bridging the gap between MFs and things like PMS.
Yeah, a huge range of fund types covered. Now, when you invest, you often have choices on how you get the returns, right? The investment options.
Exactly. Usually you choose between an income distribution cum capital withdrawal option, used to be called the dividend option, and a growth option. How you choose affects how you get paid and how it's taxed.
So the income distribution option gives you periodic payouts.
Yes, the fund distributes some profits as dividends. You can often choose to reinvest these dividends, automatically buy more units. Key thing. When a dividend is paid, the NAV drops by that dividend amount per unit. And it's wise to check if the payout is just profit or includes some of your original capital.
And the growth option. No payouts, just NAV growth.
Correct. All profits are kept within the fund and reinvested. This makes the NAV grow over time, assuming positive returns. You only get the money when you sell your units. It's about capital appreciation.
The chapter also mentioned triggers. Automating buy-sell decisions.
Yes, it's a neat feature. You can set conditions like sell my units if the NAV hits X, or transfer from Fund A to Fund B if the market index drops by Y%, or even based on a specific date. It automates actions based on your preset rules. Hands-off investing, potentially.
Okay, so you've picked a fund, an option. What's the actual process for investing, redeeming, switching? Let's talk mechanics.
For a first-time purchase, you'll fill out an application form, KYC details, bank info, nominee, which fund, etc. Can it be physical paper or online now, mostly?
And if it's an NFO, the initial launch.
You invest during the specific NFO window, submitting the form and payment to the AMC or collection centers. After the NFO closes, the fund usually becomes available for ongoing purchase at the daily NAV, subject to cutoff times and getting clear funds.
Making additional purchases in a fund you already own should be easier.
Much easier. You just need your existing folio number, that's your account number, with the fund house. No need to fill out all the personal details again. Just specify the amount and fund.
And getting your money out redemption.
You submit a redemption request, physical slip or online. Specify units or amount. Signature needs to match records if physical. Processed at the day's NAV, minus any exit load. Money comes to your registered bank account check, NEFT, ECS, etc. Liquid funds might have faster options like IAF for smaller amounts. There are also rules for NRI redemptions, minimum amounts you can redeem, and minimum balances you need to keep. And in rare crisis situations, SEBI might allow temporary redemption halts. If a fund winds up, SEBI requires it be listed to give investors an exit path.
Switching between funds in the same fund house.
Yep, that's a switch. You redeem from the source fund and immediately invest the proceeds into the target fund. Remember, the redemption part is taxable, and exit loads might apply. You specify source, target, and amount units.
And dividend reinvestment automatic compounding.
Exactly. If you choose that sub-option under the income distribution plan, your dividends automatically buy more units at the post-dividend NAV. Helps returns compound over time.
Okay, process covered. For those who like discipline, there are systematic transactions, automating things.
Very helpful tools. They automate regular investing, withdrawals, or transfers. You commit upfront to the amount, frequency, date. Transactions happen automatically at the applicable NAV. You can usually cancel them with some notice.
Let's start with SIPs, systematic investment plans. Super common, right?
Extremely popular. You invest a fixed amount regularly, say monthly, into a chosen fund. Great for long-term wealth building, even with small sums. And you get rupee cost averaging.
Meaning you buy more units when prices are low, fewer when high.
Exactly. Over time, it can lower your average purchase cost. Setting up is easy. Choose the fund, amount, frequency, date, duration, payment mode, like a bank mandate. You can usually cancel or renew them.
What about the opposite, getting regular money out? SWPs.
Right, systematic withdrawal plans. You withdraw a fixed sum regularly from your investment. Good for generating income, like in retirement. You set the fund, amount, frequency, date, duration. Each withdrawal is a redemption, so taxes and exit loads might apply. Money goes to your bank. The plan stops if your balance gets too low. Some funds might let you withdraw just the gains. You can cancel anytime.
STPS, systematic transfer plans, moving money between funds systematically.
Yes. Periodically transfer a fixed amount from a source fund to a target fund within the same AMC. Useful for de-risking, maybe moving from equity to debt as a goal gets closer. Uses your existing folio.
And DTPs, dividend transfer plans.
Similar idea, but it transfers the dividends earned in one scheme, which must be in the income distribution option, automatically into another target scheme. Could be used to book profits from equity to debt or average into equity from debt dividends.
Lastly, value averaging investment plans.
Oh.
Sounds more complex than SIPs.
They are. Instead of a fixed amount, you invest a variable amount each time. The goal is to make the total value of your investment increase by a fixed target amount each period. So you invest more when the market's down and less when it's up to hit that target value growth. More complex calculations, less commonly offered than SIs, though some AMCs have variations.
Okay, lots of systematic options. Now, a key choice, direct plan versus regular plan. What's the deal here?
This is crucial. The difference is how you invest and whether a distributor's commission is included in the cost. Regular plan is the standard one you get if you invest through a distributor or advisor. Its expense ratio includes their commission.
And direct plan.
Direct plan means you invest directly with the fund house or their R&T agent, bypassing any intermediary. Because there's no commission to pay, the direct plan has a lower expense ratio than the regular plan of the exact same fund.
But the investments inside are identical. Same stocks, same bonds.
Identical portfolio, same fund manager, same strategy. But because the direct plan's costs are lower, more of the fund's return reaches you, the investor. Over time, that lower expense ratio can lead to significantly higher net returns compared to the regular plan.
So why would anyone choose a regular plan if direct is cheaper?
Well, the regular plan includes the cost of advice and service from the distributor or advisor. Many investors find that guidance valuable help selecting funds, managing the portfolio, handling paperwork. If you're comfortable doing your own research, making decisions, and handling the process yourself, the direct plan is likely the more cost-effective route. An advisor should explain both options clearly and help you decide which suits your knowledge, time, and willingness to manage things yourself, including how to actually transact in direct plans.
Okay, we've covered a huge amount of ground. As we wrap up this deep dive, what are the absolute key things someone should take away about mutual funds?
Well, hopefully you've got a much clearer picture now. What they are, how they work, the sheer variety available for different goals and risk levels, understanding the players, the regulations, the core concepts like NAV, objectives, and especially the impact of costs like expense ratios between direct and regular plans.
And we really hope that you, listening in, feel more empowered, more confident about navigating this whole mutual fund landscape. The aim was really to cut through the complexity and just give you the essentials.
Yeah, this deep dive hopefully shows that while it might seem daunting at first, breaking it down helps. Understanding these fundamentals really empowers you to make smarter choices that actually align with your own financial situation and goals.
So here's a final thought for you to chew on. Thinking about your own goals, your comfort level with risk, and how much time and expertise you realistically have, which specific type of mutual fund, or which investment mode like direct versus regular, genuinely feels like the best fit for you. It's definitely worth pondering that. Maybe even revisiting your current investments based on what we've discussed. You might also think about next steps like, okay, how do I actually compare direct and regular plans side by side? Or what are the exact tax rules for that debt fund versus this equity fund? Great questions for further digging.